Hello, everyone, and welcome to MEFG in Conversation, our series dedicated to exploring timely topics with industry key leaders in the innovation ecosystem. My name is Priya Rajan, and I'm the Managing Director responsible for national VC coverage at MEFG's Tech Banking Group. Today, I'm so excited to welcome Hans Dang, Managing Partner at Notable Capital, previously GGV Capital US. Notable Capital is a US-based firm with $4.2 billion of assets under management, focused on early to growth stage companies in cloud infrastructure and business and consumer applications across US, Israel, Europe, LATAM, and select global opportunities. Hans needs no intro. He's a legend in the VC ecosystem and consistently recognized as one of the top leaders. Midas List 13 times, made top 10 fifth year in a row, with 27 plus unicorns, including Affirm, Airbnb, Peloton, Poshmark, Twins, StockX, and more. Hans is known for investing in high-value tech startups. Excited to welcome Hans. And Hans, thank you so much for joining us.
Oh, thank you so much, Priya, for having me. It's a pleasure to be here.
Of course. Today, we're going to talk about topic one that you deeply care about, state of the markets for FinTech and e-commerce.
Right.
Hans, can you share a bit more about your incredible journey till date? I know you did a brief stint in banking, and what got you to where you are today, and also the fund's investment thesis.
Sure. I'll start with the first one, a bit more about my background. I'm a Taiwanese American. I was born in Taiwan, came to the US when I was 13. So I did my middle school and high school in LA. And I still like a lot of LA-based sports teams as a result. Then I came to Stanford for college. That was late 80s and early 90s. So I was there. By the time I finished at Stanford, Mosaic came out, and then IE came out 2 years later, and Netscape went public. So it was the perfect time to be at Stanford and see the rise of the PayPal mafia that came afterwards. So many of the friends and acquaintances I end up getting to know ends up doing very interesting things in the internet space. Sometimes you have to be in the right place at the right time. After Stanford, you're right, I started my career in banking. Moved to New York, worked at Merrill Lynch in M&A, did that for 2 years. It was there I realized that the manufacturing is moving out of the US. I had multiple sell-side assignments to help businesses to sell in fireplace, in home accessories, to sell because of increasing competition from Asia. For my third year, because of the Asia competition, I thought it would be interesting to see what's like to work there. So I spent my third year in corporate finance in Hong Kong, and that's where I saw both the rise of China in the very early stage, as well as semiconductor industry developing in Taiwan. So I remember visiting UMC, TSMC, and other fab and design houses like MediaTek in Taiwan at that time. So just very fortunate to be able to see what we're seeing today 30 years ago as it was developing. I ended up doing 2 startups, both of them Silicon Valley connected, over the next 6 years, and then joined Bessemer at the end of 2004, 2005 here in Silicon Valley, and then very shortly thereafter moved to Asia with Bessemer to do business development and investments cross-border between Silicon Valley and Asia. And those kind of experiences set me up to be able to have a chance to be at Notable now and have the global perspective. They help me to spot trends and work with our founders to realize their vision, especially in FinTech, e-commerce, and AI. So I've been very fortunate to have the career I've had, and also know that it's the founders that make our career work.
And can you talk a little bit more about Notable, the newest avatar of GGV US?
Sure. GGV has been around for 24 years. So it has been a very interesting journey to see a global business that started in Silicon Valley and Singapore to scale well. But due to the geopolitical tension and just all of dynamics between China and the US, it was a lot easier for us to separate the 2 firms and pursue what we think makes sense in our respective regions. So we made an announcement to split in September last year and did ahead of schedule and made an announcement about our separation on March 29th this year. So it's bittersweet. This is now the next phase of our chapter. But at Notable, we love the name we picked. It's about our notable founders, about their notable ideas, about their notable causes, and our notable investors. So the attention's on them, and we are happy to join their journey. They help them realize their vision and help them to scale their businesses.
Amazing, amazing. And of course, as a 13-time Midas list, I have to say that again because it's not as often that people have that. And number 10 investor globally. No question that you've mastered the pattern recognition in choosing promising companies across sectors and geos globally to back early on and support them through their journey. I'm sure a lot of people ask this question to you, but I'm curious about what common patterns or attributes do you look for, and how do you apply what you've learned over the years to discover where you're going to invest in next?
Well, I don't think anyone's born to be a great investor. I think you have to have the luck of seeing the right patterns early on, and thereafter you really have to learn from other people's lessons. I still remember a Time magazine article on the Kairatsu formed by Klein & Perkins and then Benchmark around eBay, around Amazon, around Netscape, around Sun Microsystems. So those type of insights connected me to my love for history, for sociology. So I always feel that VC is not just a business of economics, of numbers, of dollars and cents. It's also about sociology, understanding the shifting dynamics in society that we live in, and as well as psychology, especially human psychology of the founders we work with and the teams that they're managing and the organization that they want to build. So you got to have exposure to all three disciplines to have a chance, and that's not including having the technical expertise for whichever sector you have to be good at investing. So these are all things that intrigued me when I was young, and just seeing how that everything I enjoyed doing as a student has relevance to now working as a VC and as a former founder. So these are things that help me to spot patterns. And I also think that as a VC, when you look at the other great ones, people usually have some kind of thesis, an idea where the world's heading. At the same time, we all know that it's the founders that make a huge difference. Without the right founders, even you have the right vision, nothing gets done. So I always think that ideas are, maybe they may not be cheap, definitely is about, somewhere 5%, 10% of success. The other 95% really comes down to the founders and their execution. So that's why we choose the name Notable. The ones that make it work are truly, truly outstanding and notable.
And any qualities specifically that you, taking the technical aspects outside, any characteristics that you look for? Okay, that there's a winner there, or
Right.
somebody that you can bet on.
Two of my favorite examples would be Brian Chesky at Airbnb and then Max Levchin at Affirm. Both of them have that founder market, founder product fit. For Brian Chesky, definitely is founder founder market. I think he is someone who had seen a pain point about a place to crash on short-term basis. Hotels are not great. Inventory is fixed, so it doesn't deal with the fluctuations in demand, and be able to see that experiment several times, go through several years, and be able to stick with it until Airbnb become Airbnb. It was not easy, but it just felt like that's a problem given who he is. He's destined to solve. And I still remember meeting him for the first time in 2014, him talking about experience with the same kind of passion that he had to start Airbnb in the first place. Those are kind of things that's truly, truly amazing. When I look at Max Levchin, I met him first in 2009 and then backed him in 2016 at a firm, and just seeing how he's just destined to build something for FinTech financial services. He briefly took detour with web games, with Slide and Facebook, but really his passion is with PayPal and Affirm. And I wouldn't be surprised if it ends up doing something that's FinTech and AI related later, from position of strength at Affirm. So you can just see some founders have the knack for certain area that's just very suitable to do.
That's amazing. That's two great examples. The VC landscape, you've seen so many of these ups and downs, and the landscape evolved over time with macros, highs and lows. And as you mentioned earlier, you're a cross-stage investor with 27 plus growing unicorns in your portfolio. 9 of your investments completed IPO in the last 5 years. I mean, I know it's a hard question, but how do you time it? How do you time it right on when do you invest in them? Because especially given that you're kind of stage agnostic, and how long to hold and when to kind of think about exit scenarios.
Yeah, it's not easy to be a multi-stage investor for sure. That's why I think it's easier to be guided by the by thesis. At the same time, how to time exit is not easy. None of us have a crystal ball. So we learned this the hard way. We over time we realized that it's better to take something off the table pre-IPO if the company's doing well and founder need to have some liquidity. We don't mind to have some liquidity, take some money off the table before IPO. And then post-IPO over a year, 2 year, 3 year period, just have the discipline to exit periodically every quarter. Having a fixed percentage is the best way to diversify across time. And of course, if you see a bull market or a huge bearish market that happens suddenly quickly, it's harder to manage. But if you're playing a long game over a 10, 20, or 30-year period, having that discipline to exit in a fixed according to a fixed schedule, I think is the best way to manage exits. You don't need to be perfect. You don't need to time it, but consistently over a period of time, you'll be protected both on the upside and the downside.
Yeah, great. And you've invested, as we chatted about, in some of the best fintech and e-commerce companies, Airbnb, Peloton, Affirm, Poshmark, and more. Specifically on the e-commerce, we have seen, as you mentioned, a significant shift in consumer behaviors in the last few years. COVID happened, and then inflation. How did that impact, if any, your views on the sector, and any specific trends you're excited about? I know Ibotta just, filed, and so any consumer trends that you can drive from that as well.
Definitely, you see Gen Z becoming a bigger influencer in the way as a consumption class, and you see influencers and on YouTube, on IG, on TikTok, playing a bigger role, influencing their followers as well. So those are two undeniable trends. And with the macro factors you cited, whether it's inflation or market correction, there's a lot more volatility. E-commerce was super hot during the first half of COVID. Towards the end of COVID, it just plateaued and went down. So you will definitely have ups and downs in a short period of time. But if you take Affirm as an example, buy now pay later has been around, but at the same time, you look at buy now pay later as a percentage of e-commerce, it's still less. It's still in low single digit, and so e-commerce, despite the volatility, is still growing. With at 20% penetration rate and continue to grow, it could be somewhere between 30, 40, even 50 by the time this is done over the next 10-year period. And you can see how buy now pay later as a category will continue to do well because it's still only single-digit penetration of just e-commerce, not even as a percentage of retail. So if you're patient, you can weather the volatilities. Then these are kind of business, especially the one with as good a credit risk modeling capability that Affirm has a long growth sort of room ahead. So when I look at e-commerce, there's going to be innovations on the credit side with something like buy now pay later with Affirm. There'll also be things going on the supply chain side. Supply chain kind of driven by IT, driven by knowledge, data sharing, and over time AI as well. And on the supply chain side, you see the rise of a Temu and the Shein from Asia to here, and you see companies like Quince doing well on the higher end segment. They all work with the suppliers very closely and figure out ways to cut down the number of days for working capital needs and make sure people suppliers get paid earlier and get information on trend shifting earlier as well. So you introduce efficiency in the supply chain, everyone can benefit and wins. So both on the demand side with the rise of influencers and Gen Z, and also with innovations on the credit side, and on supply chain, IT, AI, knowledge sharing, moving things to a cloud, it's the whole supply chain demand to supply just gets more efficient. And so that is not easy thing to crack because you're working across time zones differences, cultural differences, teams in multiple areas. You want to diversify supply chain. So it's a complicated problem to solve. That's why not many companies can do that.
And they have you to help guide them through that process.
It's not easy, but it's been fun working with founders who can make that work.
Yeah. And, FinTech was no different. It has been an interesting few years. 2020, 2021 was like a peak, as with other sectors. And we saw a huge correction going into 2022, 2023. How do you see that sector evolving in this year, both in private markets and public markets?
I'm actually very bullish on FinTech, even though the market seems to be very down on FinTech. At the same time, I also realize that there's always something hot at the moment. And right now, AI is that. And we all know that AI will be around 10, 20 years. It's a long-term secular growth trend. At the same time, I also am mindful, having done this for almost 20 years now, you don't want to buy high and sell low. FinServ as a category, market cap for FinServ companies worldwide is over $10 trillion. FinTech as a category, just the public companies that are FinTech, the market cap is less than 5% of FinServ. And so there's, and FinTech companies, the good ones are growing faster than the banks and insurance companies. So you can see that over a longer period of time, FinTech valuation should go up, and especially aided by AI, which means that automation of workflows inside these financial institutions, and there should be more and more growth ahead for FinTech. So if other people are negative or pessimistic, and long-term growth trend is good, this is the best time to invest and scale founders who can make a difference.
Yeah. And, talking about AI, in one of your earlier talks, you mentioned that AI is having its iPhone moment. And where do you see the most promising companies in AI and FinTech? I know you just mentioned workflow automation. We see quite a bit of pings. I get pings all the time in trying to see how we and other banks could adopt some of those. Where do you see opportunities, and any examples of companies that could be early ones that you're kind of working with at this moment that kind of stands out, and ones that as a bank we should be watching out for?
Yeah. We definitely are excited about some of the companies in our portfolio, or some companies that we're close to. You definitely see that besides automation or workflows, you see more business intelligence happening with AI. And you also see that even software development, even customer service, customer center, there's just a lot of areas where we need a lot of manual labor to do compliance work, to do tax preparation work, even with double checking numbers for ledgering and reconciliation and so forth. A lot of that could be managed by AI, and the number of people required will go down tremendously. And this is very early. So some of the companies that we have met or know of now, even though we may not be investors in, we think are interesting, like Emma in Mountain View, working with the BPOs. You look at Slope in San Francisco, that's doing accounts receivable, converting that to cash sooner, faster. You look at Clarity, also out of San Francisco, that's putting sort of a compliance and legal work with revenue recognition, and I already have customers like Zoom, OpenAI, and Okta. There are a number of companies out there that are still very, very early, but doing very interesting things. And for banks, it's harder to innovate internally on something completely new. So partnering with others who are doing that makes sense. My partners and my colleagues, Chelsea and Jeff, invest in Arteria out of Toronto. The CEO, Shelby's amazing. She spun off the business from Deloitte, Canada, and she's working with JP Morgan, Citi, and others, and doing a very good job by helping them to take legal documents, like loan documents, and take out the numbers out of legal documents to make sure that gets used and summarized within the firm. So the life cycle of the contract management, contract lifecycle management is becoming a bigger area for innovations and efficiency to be had. So these are just companies that are very early, like not even definitely first inning, not even the first out, kind of early in the process. So I think a number of them will end up being quite interesting over the next 10 years.
I mean, it's heartwarming to hear Slope because I've known Alice since her Berkeley days, and to see where they are today, it's really heartwarming. So you're absolutely right in terms of market opportunity there.
Yeah.
It's all about the timing and continuing to be there.
Yeah.
Can you share your perspective on how, from a broader sense, exit markets for fintech and e-commerce companies would play out, like from your predictions for 2024?
I think 24 is a year where the e-commerce companies, you see a number of their operation more stabilized. Like you mentioned, 2021 was huge growth. 2022 started seeing correction. 2023, several companies went through downsizing, and 2024 it was start seeing some of the winners having more normalized operations. And you also see new entrants, like TikTok launched TikTok Shop and is growing rapidly here in the US and elsewhere. And so companies that can take advantage of supply chain innovations and understand sort of demand generation through new channels would be very, very interesting. We like, if you look at just even say the energy drinks category with Celsius, Monster, and others, and we would like a particular company that's representing, energy drink designed by women for women consumers, Gorgie. We worked with Michelle back in 2016, 2017, when she had her first exit, doing athleisure wear, a company called Lively. And so seeing her doing it a second time in energy drink has been a fascinating journey already. And she's very early in that process to do something we think quite big. And so brands and platforms that understand users, understand the trends better, will have a fast growth period in 2024 and 25 and beyond. But it is definitely, you start seeing a bifurcation of different players in e-commerce, whereas when Shopify started and grew rapidly in the last decade, it seems like everybody was growing. And by 2019, 2020, and 2021, they start seeing changes. And definitely over the last 2 years, you see bifurcation.
Yeah. And, one advice would you give, as we're wrapping it up today, one advice would you give to the founders listening today?
And think, an old adage that this is the best of times, the worst of times. And when things are going really, really tough, it's also the time where there's less distraction. And so if you are in a category that's not AI, not super hot, you actually get a chance to build a real business. And whether it's 2001, 2002, whether it's 2009, 2010, and even back in the first half of the 90s, great companies are built and started when things seem to be going tough. Facebook was started in 2003, 2004, Uber 2008, 2009, and these are, and Airbnb started around the same time as well. These are times when it's not easy, and people were down on social networking in 2003, 2004, thought that Google has won it already. Who needs ride sharing and share your home with a stranger? So a lot of things were just poo-pooed early on. And if the founder is persistent and have the right group of backers and advisors to support them, you can build an amazing business over a time period. One really good example that my partner love to use is a company called Slice. They enable the mom and pops pizzerias to have what Domino Pizza has in terms of IT and capability to deal with the demand increasingly going digital. And the first 8 years of Slice time, they had a $5 million in revenue. Get to $5 million in revenue per year, it took them 8 years. Over the next 5 years, they scaled to $100 million in revenue. So good things do take time. It's an outlier to see something happen quickly, overnight success. That doesn't happen really often, and if at all. And so having the patience to build and enduring companies through good and bad times is not an easy thing to do, but the ones who can do it, they're extremely notable, and we're proud to be a part of their journey.
Amazing. Patience capital. That's the word. Super insightful. Really, really appreciate your time, Hans. Thanks again for joining us.
Thank you for having me, Priya.
Thank you all for joining us, and looking forward to seeing you all soon.